Most investors still think of this company as just another native advertising relic, a bottom-of-page box that shows sponsored content after you finish reading an article. That belief still lingers in the market, contributing to a share price in the low single digits, around $4.43 at the last close on January 2, 2026, despite a series of business shifts that suggest Taboola is quietly becoming something very different from its legacy. What's unfolding isn't just a rebrand, it's a repositioning of what performance advertising infrastructure looks like in an era when measurable outcomes matter more than impressions or simple visibility. In its most recent reported quarter, Taboola posted nearly $497 million in revenue, up roughly 15% year-over-year, and exceeded the high end of guidance across major financial metrics. Adjusted EBITDA grew as well, reflecting improving operational discipline even as the company expands its product suite. These results were driven in part by increasing advertiser traction on the company's Realize platform, a suite of tools designed to optimize campaign performance using AI and first-party data. Management described this momentum as an inflection point, signaling that this isn't a small tweak, but a structural shift in how the business delivers value to advertisers. Adding to the strength of the narrative, Taboola has been returning capital to shareholders through an aggressive share repurchase program, reducing its share count by approximately 14% over the past year. This kind of buyback activity is a signal often noted by analysts and smart money alike. It tells the market that management believes the stock is undervalued and that intrinsic value is higher than what current prices imply. A cornerstone of this evolution is Taboola's Realize performance advertising platform, originally known for native ads tucked under articles. Taboola now positions Realize as a next-generation engine that helps advertisers achieve measurable outcomes, clicks, conversions, leads, while harnessing AI to find the most receptive audiences across a massive network of publishers. Realize taps into data from Taboola's integration with thousands of publisher partners and templates that span display, video, and other high-visibility formats. In the second half of 2025, the company made a series of strategic partnerships that extend this vision even further. Taboola teamed up with LGAD Solutions to launch a product called Performance Enhancer, which bridges connected TV exposure with measurable digital conversion activity across the open web. This collaboration enables advertisers to connect premium TV ad placements with performance metrics, site visits, conversions ROI in a way that was previously difficult outside closed-garden ecosystems. Beyond LG, Taboola deepened partnerships with major digital publishers including Time, Weather Channel, Digital, USA Today Network, Nexstar, and Slate. Positioning Realize as more than an aggregation layer, it's becoming a performance infrastructure hub that serves both publishers and advertisers at scale. The company anticipates paying over $1.5 billion to publishers and OEM partners in 2025, reflecting the breadth and depth of its engagement in the digital ecosystem. This expansion isn't happening in a vacuum. Taboola's platform now touches roughly 600 million daily active users, and its AI-backed optimization tools have begun showing measurable lift for advertisers, including lower cost per acquisition and higher engagement metrics on integrated campaigns. For legacy publishers and brands trying to break out of the limitations of social and search advertising, the blend of open web reach, AI optimization, and measurable outcomes represents a unique value proposition in a crowded landscape. At this stage, the market still treats Taboola with a degree of skepticism because the word native ads evokes memories of low-quality traffic and commoditized placements. But the business has systematically moved beyond that label. The Realize platform and connected TV integration point to a future where performance advertising is measured end-to-end, combining premium impressions with down-funnel results, a fundamental shift from traditional advertising models focused solely on reach or awareness. Realizing this shift in valuation terms is often slower than the actual business evolution, and that lag between perception and reality is where opportunities for long-term research-driven investors can emerge. Now, it's crucial to remember that stock prices do not always reflect real-time business progress. While the narrative and results point to meaningful changes, prices can lag, markets can be volatile, and no script can predict short-term moves. Always verify real-time prices and contexts before making decisions. This presentation is focused on analysis and information, not specific buy or sell advice. One of the long-term strengths emerging from Taboola's evolution is its ability to diversify not just the types of ads it serves, but the contexts in which performance can be measured. The partnerships with major media entities and technology providers like LG show Taboola's efforts to straddle both human view and measurable engagement outcomes. That gives advertisers from small businesses to enterprise brands a more unified picture of how their investments translate into action. It's this depth of integration, rather than mere exposure, that separates modern performance advertising from the traditional native ad model. Of course, there are risks. The advertising landscape is intensely competitive, with giants like Google, Meta, and Amazon commanding a large share of global ad spend. Measuring and attributing outcomes, especially across platforms like connected TV, raises technical and regulatory challenges that require constant innovation. Rapid shifts in data privacy norms could also impact how performance tools collect and use data. These challenges are real and must be acknowledged alongside any positive narrative. That's why the renewed focus on disciplined capital allocation, including share repurchases and careful margin management, matters. It reflects a company that is conscious of both growth and efficiency, a combination that tends to resonate with experienced long-term investors. Rather than chasing short-term headline metrics, the business appears to be building a foundation for sustained performance infrastructure relevance. In summary, what once was perceived as a simple native ad company is increasingly positioning itself as an AI-infused performance advertising infrastructure provider with expanded publisher relationships, measurable outcomes, and strategic positioning in next-generation channels like connected TV. Whether the broader market fully reflects this yet is uncertain, but the underlying business signals suggest a narrative shift that deserves thoughtful attention. Always check live prices before acting. Markets move, and analysis should be grounded in real-time context. If you found this breakdown useful and want calm, research-driven insights on overlooked stock opportunities with real-world relevance, consider subscribing. It helps ensure we can continue delivering deep analysis instead of hype and noise. This isn't speculation, it's structural transformation. And understanding that difference is what separates short-lived narratives from lasting investment frameworks.